So someone recently asked the question, why would I add a term insurance rider to my whole life insurance policy? The answer to his question was, it'll give you the most cash value. Whenever you look at a whole life insurance policy with versus without a term insurance rider, you'll always see more cash value from start to finish in the option where you have a term insurance rider attached, assuming we design it appropriately and maximize the cash value, which I'm going to show you exactly how to do as we progress through today's video. What we're going to start with, though, is looking at just a basic whole life insurance policy where we just pay the premium. Then we'll look at a policy where it's set up for cash value, but it does not have a term rider. And then we'll close by looking at a policy that has a term insurance rider attached. So with a whole life insurance policy, there are some terms to be aware of. We have what is called your base premium, your paid up additions rider, your term insurance rider, and then your MEC limit. MEC stands for Modified Endowment Contract. So with a whole life insurance policy, people are typically attracted to this product because of the cash value. When you look at the cash value in a whole life insurance policy, it is a safe place to put my money, meaning it will continue to grow over the years regardless of what occurs in the economy, stock market, it goes nowhere but up. It's liquid. I can access it any time without any penalties. And it has a unique loan feature in the sense that if I borrow against my cash value, I continue to earn dividends and interest on the amount that I borrowed and what I have not borrowed. So I receive constant compounding. And then third, it's tax-free, as long as I don't mess it up. So with a whole life insurance policy, if you access the cash value, specifically through a loan, you can access it tax-free, and you do not need to pay loans back. However, if your policy becomes what is called a modified endowment contract, then when you access the cash value, it is not tax-free. Now you have to pay ordinary income tax on the gains, and if you access it prior to age 59 and a half, you have a 10% penalty tax. That's if a policy becomes classified as a MEC. I promise this is all going to tie together with the term insurance rider. So what we want to make sure is that we never pay more money into the policy than whatever our MEC limit is. So let's go through these three examples. We'll start with a traditional whole life insurance policy. Let's pretend this is you. You want to pay $20,000 per year into a whole life insurance policy. You're going to go with the most common approach where you just buy a life insurance policy. Meaning when we look at your $20,000 payment here, all of it goes toward your base premium. Nothing goes toward the PUA piece. So what that will result in for you is in the first year, your cash value will be ugly. It'll be about zero. Your life insurance benefit will be large. This will depend on your age. It might be about $1.3 to $1.4 million. Again, depends on your age. It also heavily depends on the product you purchase as well. Now your MEC limit, which is the IRS limit that determines the maximum amount of money you can pay into the policy per year, this will also depend on your age and the product that you purchase. The guaranteed rate will have an impact on this, but that might be $40,000. What does that mean? Well, what that means is if you're paying $20,000 into the premium and your MEC limit is $40,000, that means your policy can accept another $20,000 per year into your PUA rider without triggering a MEC, which would be a taxable event. And PUA dollars accelerate the cash value growth. You'll see them show up in cash value. So to demonstrate that, let's take a look at an example. So we'll call this option B. All right. So what we've got here is you pay the same $20,000 per year. When we look at where your money is going, we see $7,500 toward the base premium, and then $12,500 toward the PUA. The premium piece does not build any cash value, just like the first example. However, the PUA piece does. You might see of that $12,500, about $12,000 or so show up in cash value. There are upfront fees with our PUA payments that the insurance company retains. The reason why there's a fee is because it does buy you some life insurance, your PUA deposit. But why people put money here is to grow their cash value. So here we've got a $7,500 premium. Your death benefit in this example might be about $550,000. What's driving that death benefit is the premium. If you say, I don't care about the death benefit, I'm interested in the cash value for these reasons, well, the important piece here is that the death benefit will have a direct relationship to your MEC limit. So your MEC limit now is about $20,000. These are not exact numbers. A $1.3 million death benefit, for example, will get you closer to a $50K MEC limit. But back to this. $550, your MEC limit is about $20K. So what this means is if your goal is cash value and you get a policy without a term insurance rider, the most you'll see in the first year cash value will be about $12K, and the most you can pay into PUAs per year is about $12,500. Purpose of adding a term insurance rider. Let's take a look. And this is why I would do it right here. Option C, ready? Same company, same product. You pay the same $20,000. Your base premium is $2,000. Now, that $2,000 premium won't give you any cash value, and it might give you a death benefit of, call it $100,000, which might give you a MEC limit of not that much money, right? Call it $5,000. You're paying in $20,000. So if you just proceed with that minimum base premium, which is really going to make your cash value look good, you'll run into a MEC, right? A taxable event. A lot of times people ask, can I put more money into my PUA rider? And the response they receive from their agent is, you can't do that because it will MEC. The follow-up question I would ask is, can I attach a term rider to keep my premium low and add more money to PUAs? The answer is yes, you can do that. That term insurance rider, let's say of $200, might give you additional life insurance of $800,000 or $900,000. It is going to depend very heavily on your age. But when you add those two death benefit figures together now, what happens to your MEC limit? Well, the term rider piece might get you another $25,000 in MEC space. Add the two together, you're at $30,000 in MEC space, where I'm paying in $20,000. So I've got more than enough. I might add a lower term insurance rider to have a lower cost because I only need $20,000 of MEC space. Depends how much I'm going to pay in. Anyway, where I'm going with this is the purpose of a term insurance rider is that it is a very cheap way. If you don't like the word cheap, think cost-effective way to raise your death benefit, which raises your MEC limit, which lets you keep your premium at a minimum because the premium piece doesn't show up in cash value in the first year. So if I keep my premium low, add a term rider for next to nothing with respect to cost, then everything else I pay in, the $17,800 here, guess what? Builds cash value. Now my first year cash value might be $17,000 or so. And I'm going to see more cash value long term as well. Let's wrap up by looking at examples of these policies for someone, all with the same life insurance company. Okay, so here we've got the illustration, stereo instructions. We're just going to look at this on Excel to make it much easier to follow. So what we have first is option A. What do you notice here? If this is you, You pay $20,000 per year, and it's all going toward the premium. So in red is your premium, purple is your PUA, 0. Your annual funding, which is what you're paying every year, is just your premium. As a result, your first year cash value is 0. If you rewind the video 30 seconds, you'll see the illustration. The first year cash value is 0. And we've got the same death benefit figure as well. Up top, we have 14 years to get your money back. The reason why we have that here is because if you take $20,000 per year times 14 years, you will get $280,000. This is the first year your cash value is equal to your total payments. All of the prior years, you have a loss. So this is a policy without a term insurance rider and also without a PUA rider. If you're interested in a whole life insurance policy for cash value, this is a fantastic example of exactly what not to do. Now, if we look at option B, here we go. You pay the same $20,000 per year. Your premium, $7,500 per year, and your PUA, $12,500 per year. There's your cash value, a little bit less than $12,000 in the first year, and your death benefit is a little bit more than $550, which in this example gives him a MEC limit of about $20,000 per year, which is what he's paying in. So the policy is set up with the minimum death benefit we could possibly have to pay in $20K per year and still be able to access this cash value on a tax-free basis, provided we don't mess it up. There's other ways you can trigger a taxable event. I would check out the video above if you'd like more information on this. But up here, we see 9 years to get your money back, meaning by the 9th year, you've paid in $180,000, and you finally have $180,000. Where a business owner struggles with this is that's a huge lost opportunity cost, especially up front, where I take more than a $12,000 hit. And this is all without a term insurance rider. So going back to the original question that the individual asked, why would I add a term insurance rider to a whole life insurance policy? The answer is because it gives you more cash value. So when we look at this option, what do you see? Well, you see the base premium, $2,000. The term insurance rider cost, $300. This is specifically a 1-year term insurance rider where the cost renews on an annual basis. It can get more expensive, but if you do things right, you can actually see it go down over time, which is what happens in most cases, at least it does with almost all of our clients where we set policies up this way. But we see the term rider cost, and then you see the balance going toward PUAs. When you add those 3 figures together, it gives you $20,000 per year. So in all 3 options, he's paying 20 grand per year. Same exact insurance company here. The difference is in the first year, check this out. He's got about $17,500. So we're stuffing that PUA rider to maximize the cash value. The break-even point is year 4 because you pay $20K per year times 4 is $80,000. By the 4th year, you have $80,000, a little bit more in this example. Now, when we look at the term insurance rider, here's how it works. We set the death benefit at $1,050,000. This also prevented a MEC from occurring. So MEC, no, which makes him feel like this. All right. So no MEC. And when we look at the term rider, what's happening? It's going down. So this is specifically referred to as a 1-year term insurance rider. How it works is we've got a whole life death benefit. The first year it's $160,000 and change. Then we've got a term insurance rider of $883 and change. Add the 2 together, it gives us the net death benefit of $1,050,000. How we came up with that is we wanted to be able to fund $20K per year without triggering a MEC and still have the insurance company let us put in $20K per year. But what happens is when you add money to PUAs, it builds cash value. That's what people are interested in. But it also grows your whole life death benefit. So as your whole life death benefit grows, what happens with the term rider is it decreases proportionately. Meaning if you add the whole life plus the term at any point in time, it's going to equal the $1,050,000. So it's like a seesaw. One goes up, the other goes down, keeping you level at that death benefit until the term expires altogether. And if you do it right, like what we see here, here's your term rider cost. Goes down over time. Now, something that drives me absolutely nuts in the industry is I see agents use scare tactics to try and talk people out of using a one-year term rider. The reason why is because they're trying to sell a higher base premium, which is where the compensation is driven with whole life insurance policy sales. But with the term insurance rider, the potential danger, what we see with the scare tactic is if you don't aggressively fund the policy with a lot of PUAs, the term doesn't go down quickly, which can result in that term cost getting so high, it'll implode and blow up. Okay, if you buy a car that needs oil changes every 3 months or every 10,000 miles, and you don't change the oil, the car is going to break down. How you prevent that is by doing what is called maintenance. So if there's a case where someone is underfunding a policy and they have a one-year term rider on, what you can do with it is just manually reduce it. So as an agent, if I saw someone underfunding a policy and that term cost got too high, I could peel off $100,000 of term. I can peel off $300,000 of term. And after the 7th year, I can remove it altogether if I wanted to. So if they're not funding according to plan, it's an easy fix. But anyway, to go back to the original question, why would I add a term insurance rider to a life insurance policy? The answer is it gives me more cash value. It allows me to commit to a minimum premium because I'm not committed to the PUA piece, and it prevents what is called a modified endowment contract, a MEC, which is a taxable event. So I hope you enjoyed this video. If you did, I'd love to hear your thoughts in the comments below. And as always, I hope this helps. Thanks so much.